Hello traders, how well do you understand central bank interventions? How do you trade during such events? The Bank of Japan is a prime example of an institution that regularly engages in currency interventions whenever the yen tends to move in one direction. Follow me in this video as I explain central bank interventions focusing on currency interventions by the Bank of Japan among others. I'm Erica Trina from Sen Securities. Central bank intervention in foreign exchange markets involves a nation's central bank buying or selling its currency to influence its value. This intervention aims to stabilize or manipulate the exchange rate to achieve economic goals such as controlling inflation, maintaining competitiveness, or supporting export-oriented growth. For Forex traders, understanding and anticipating central bank interventions is crucial as these actions can lead to significant market movements and volatility. Traders must stay informed about central bank policies, and be prepared for potential interventions to make informed trading decisions and mitigate risks. The history of Japan's interventions in the currency markets provides a detailed case study on how such actions are conducted and their implications. In 1973, Japan decided to let the yen float freely against the US dollar. This move was part of a broader global shift away from the Bretton Woods system, which had pegged currencies to the US dollar. By allowing the yen to float, Japan accepted the market-driven determination of its currency's value, which introduced new levels of volatility and necessitated future interventions. Another significant intervention occurred in September 1985, when the Group of Five, G5 nations, including Japan, signed the Plaza Accord. The agreement aimed to depreciate the US dollar, which was considered overvalued. The coordinated intervention successfully weakened the dollar and strengthened the yen, with the yen moving from about 240 to 200 per US dollar following the accord. 2 years later, in February 1987, 6 of the G7 nations signed the Louvre Accord. This agreement aimed to stabilize currencies and halt the dollar's decline, which had become too pronounced. The yen was part of this coordinated effort to stabilize global currencies, maintaining a level around 150 per US dollar. Then, on January 4, 1988, the dollar fell to a post-World War II low of 120.45 yen in Tokyo trade. The BOJ intervened by buying dollars and selling yen to prevent further appreciation of the yen, which was hurting Japanese exports. In the early 1990s, the BOJ intervened several times to support the yen by selling US dollars. This period was marked by efforts to stabilize the yen amid volatile global market conditions. In 1993, the BOJ continued to sell yen throughout the year to curb its strength, as a strong yen was seen as detrimental to Japan's export-driven economy. From April 1994 to August 1995, the dollar sank to a record low against the German mark and a post-war low against the yen, dropping to around 79.75 yen per US dollar in April 1995. The United States, often with Japanese and European central banks, intervened repeatedly to prop up the dollar. During the Asian financial crisis of 1997 to 1998, the yen weakened significantly, reaching nearly 148 yen per dollar in August 1998. Despite US authorities joining the BOJ to buy yen, the currency's weakness persisted. This intervention aimed to stabilize the yen and prevent further economic instability. From January 1999 to April 2000, the BOJ sold yen at least 18 times, including operations conducted via the Federal Reserve and the European Central Bank, ECB. These interventions aimed to prevent the yen's strength from choking off economic recovery, with the yen trading between 105 and 125 per US dollar during this period. Despite these efforts, the yen continued to strengthen. After the September 11 attacks in the United States, the BOJ intervened in September 2001 to sell yen. The ECB and the New York Federal Reserve operated on behalf of the BOJ to stabilize the currency market. From May to June 2002, the BOJ intervened again to sell yen, often with support from the Federal Reserve and the ECB. Despite these efforts, the yen continued to gain value, which concerned Japanese officials regarding the impact on exports. In March 2004, after a 15-month campaign to curb the yen's rise, Japan ended its intervention efforts, having spent more than 35 trillion yen, over $300 billion. This massive intervention highlighted Japan's commitment to managing its currency's value to support economic stability. In more recent history, Japan intervened in the currency market for the first time in 6 years on September 15, 2010, selling yen to stem a rise in the currency. This intervention was triggered after the dollar hit a 15-year low at 82.87 yen. Following the massive earthquake and tsunami on March 11, 2011, the yen spiked to a record high on speculation that Japanese firms would repatriate foreign assets for reconstruction. On March 18, 2011, the Group of Seven, G7, nations jointly intervened to stem the yen's strength. Japan intervened again in August and October 2011 to curb the yen's gains, which officials feared could derail the recovery from the economic slump triggered by the earthquake and tsunami. The yen had become too strong, reaching levels around 75 per dollar, which was detrimental to Japan's economic recovery efforts. In 2022, Japan's government and central bank issued a rare joint statement on June 10, expressing concern over the sharp falls in the yen after it weakened beyond 134 per dollar. This was a signal to the markets that the authorities were monitoring the situation closely. On September 7, 2022, top government spokesman Hirokazu Matsuno expressed concern about rapid and one-sided moves in the currency market after the yen weakened beyond 143 per dollar. This statement was intended to signal that the government might take necessary steps to stabilize the currency. The Japanese government intervened in the foreign exchange market to sell dollars and buy yen on September 22, 2022, following a BOJ decision to maintain ultra-low interest rates. This intervention aimed to stem the yen's sharp falls. From October 21 to 24, 2022, the dollar plunged more than 7 yen at one point, which sources attributed to yen buying by Japanese authorities. Finance Minister Shunichi Suzuki declined to confirm whether the government had intervened, but the market reaction suggested significant intervention had occurred to stabilize the yen around 150 per dollar. In 2024, the BOJ has also faced ongoing challenges in stabilizing the yen. On March 27, the BOJ, Finance Ministry, and Japan's Financial Services Agency held an emergency meeting after the yen fell to a 34-year low of 151.97 per dollar. They suggested readiness to intervene to stop disorderly moves, highlighting ongoing concerns about yen stability. More recently, Japanese authorities likely intervened in the currency market to signal that 160 yen to the dollar is their limit. Japan's currency surged by as much as 5 yen against the dollar after hitting a new 34-year low on April 29, 2024. Traders cited yen buying intervention by Japanese authorities for the first time in 18 months. By this time, markets had been anticipating that Japan might step in to support the yen after the currency fell more than 10% against the dollar this year. For Forex traders, these historical interventions by the BOJ provide valuable insights into potential market movements, and interventions by other central banks as well. Interventions often lead to significant volatility, creating both opportunities and risks. Traders should stay informed, regularly monitoring news and statements from the BOJ and other financial authorities. Understanding the economic context and potential triggers for intervention can help anticipate market moves. Additionally, traders should analyze market sentiment and positioning, as interventions often occur when market moves become overly one-sided or speculative. It's important to note that effective risk management is also a must when trading. Trades should always consider using tools such as stop-loss orders, which can help protect against adverse market movements, especially given the sudden nature of interventions, which lead to rapid and large price changes. Being flexible and ready to adapt trading strategies based on the likelihood of intervention is equally important. This might involve reducing position sizes or adjusting leverage to mitigate risk. Of the Bank of Japan's interventions in the Forex markets over the past several decades demonstrates the critical role central banks play in currency stabilization. These actions are driven by the need to support economic stability, control inflation, and maintain competitive export levels. For Forex traders, staying alert to potential interventions and understanding their historical context is essential for making informed trading decisions and managing market risks effectively. Thank you for watching.